Welcome everyone to Neuro Capital's update. Thank you so much for making the time in your diaries to come join us for this. I know that Paul and his team have put in a lot of effort into getting some really cool information to share with you all. So I'm going to hand over to Paul. And yeah, if you have any questions throughout, please put them in the chat. And then at the end of the presentation, we will have a time to answer those questions. So yeah, if you think of anything along the way, please put it in the chat. So over to you, Paul.
Thanks, Sarah, and thanks everyone for your time. Obviously, a lot's going on in the last week. So I think timing of this is pretty good in terms of, what's going on to give you guys some clarity around what's going out there. Obviously, the situation is still quite fluid, but there's a lot, of movement and development and what's been going on, particularly with the tariffs. And as always, it does provide a lot of good opportunity. So, I'll do a presentation for about an hour, and then anyone who needs to leave after that, feel free to. We'll still, applying for CPD points. You'll still qualify for that. But anyone who wants to hang around a little bit and have ask any questions, you're very welcome to. So I think we'll try and stick on for another couple of minutes after the presentation and just answer any questions. But yeah, so get straight into it, guys. Obviously, a lot happened in the last week. Both locally and globally, actually. So you obviously had the Trump tariffs, but you also had local, with approving the voting of the fiscal framework on the new budget and what that means for the GNU, and obviously a lot of noise around that. So, and actually they both happened on the same day last week. So it wasn't even a busy week; it was a busy day. One day you had two big announcements. But yeah, a lot going on. Some weeks you have nothing happening, and other weeks you have everything happening at the same time. So a lot going on, but it has provided, I think from a portfolio point of view, things have held up well, and we're looking just to take more now to take advantage of opportunities. But to kind of paint the picture and talking about Trump first, so what's going on in the US, what's going on globally, I think that's the biggest story at the moment. Just to kind of put this in context and really what Trump ran on. So when Trump came into office in a second term, he ran on a couple of things. The one thing was he definitely wants to rejig trade. He wants to bring trade back to or manufacturing back to the US. That was a big part of the ticket that he ran on. He wants to couple that with tax decreases, which haven't come through yet. We'll talk a little bit about that just now, but he wants to kind of almost subsidize a lot of the take from income tax with tariff. So he wants to kind of change the revenue of the US government in terms of getting less from tax or less from income tax and more from tariffs. We'll talk about that. And then fiscal, and then also covering sort of some of those, the offset of the tariffs with things like subsidies. And then obviously, looking to shrink the government a little bit, so bring in less revenue and then cut expenses. Because obviously, the US is a 36 trillion rand of debt at the moment. So US government debt, not trillion rand, $1 trillion, excuse me. $36 trillion of government debt at the moment. So it's a huge, huge amount of government debt. That something needs to be done about, and Trump reckons whether you can debate him, but he reckons he has a solution to that, and this all forms part of that solution in trying to get the US's fiscal framework a little bit more sustainable long term, and then bringing down regulations, so bringing down the size of the government, bringing down government expenses, and then offsetting that with different revenue streams or changing the mix of the revenue streams that he's had up to now. So if we get into the tariffs, we just put it in context, really what Trump is saying, and you can really, I keep using Trump, and I don't say the US government, because I think a lot of this is driven directly by Trump himself. So, even when you look at the tariff announcement from last week, it seems to be, obviously he's got his economic advisory team, he's got the Secretary Treasury, Scott Bessent, he's got all these guys behind him, but it seems like a lot of it is being driven by him. We've been watching interviews and things after the fact, and a lot, it seems that, kind of the guys weren't expecting as big of an announcement as we got, or, it's almost a little bit like, if you remember the Rubicon speech in South Africa, kind of government themselves were a little bit shocked after the speech. Not as bad as that, but I think a lot of the rhetoric, you've got to understand the man behind the policy as well, and we'll talk a little bit about that, but a lot of rhetoric at the moment. But essentially what Trump is trying to do is, if you look at US manufacturing value added as a percent of the of the US economy over the last 180 years, post World War II, it has just been completely hollowed out. So if you look at manufacturing as a percentage of the economy post World War II, around the Bretton Woods time, above 25% of the economy. So 25% plus of the US economy was manufacturing, making stuff. And over time, as the world is globalized. The US is actually, I mean, during Bretton Woods, post World War II, the US actually it was a global, I mean, NATO, the UN, these all come out of the Bretton Woods conference, essentially was to try and enrich the rest of the world. So what the US said was, we've all come out of this war. European countries are quite impoverished. They've come out of a war. How do we assist them? How do we help them to essentially grow? And because if they become rich, essentially the US becomes rich as well. And at that time, there were a lot of tariffs imposed, one-way tariffs, the tariffs from European countries at that time into the US. And what that started to do was cause this hollowing out. US companies with globalization started to offshore all their manufacturing ability. And then what happened in the 80s is you had the neoliberal world order under Ronald Reagan, and that was not the Bretton Woods. That wasn't just about Europe. Now that was a global thing. So saying like, how do we bring China into the mix? How do we help China liberalize? And what happened is the US played a role in helping other countries liberalize and get wealthier, but at the same time, the negative effect of that was actually kind of hollowing out their manufacturing base, because what people found out was that it's cheaper to manufacture in these emerging economies and these cheaper economies. And, that obviously has an effect on the worker in the US. Now, the reality of the situation is that, if you look at this manufacturing percentage, it's not like the US is not getting value for this. So yes, the percentage of manufacturing has dropped out quite significantly, and the US is importing a hell of a lot of goods globally. But if you look at, I mean, they're getting a value-added product or good for that, for paying that money away. So for Trump, but the issue for Trump is actually not economic. It's actually security. So when Trump launched these tariffs, or this tariff announcement last week, he actually did it via an executive order, and he was able to do it via an executive order because he imposed a state of emergency. And a state of emergency was essentially that the US is under threat. Let's say that you get a global war or something like that. The US is under threat because it doesn't have security over its own goods. And it's something that the Trump administration has talked about quite a bit. If you listen through the noise, they've been talking about what happened during COVID. And COVID was quite an eye-opener for a lot of these nations. You can look in Europe. Europe realized how insecure their energy supply was. They started having to rely on places like Russia, for example, after it attacked Ukraine. Or when global supply chains closed down during COVID, people realized that, wait, to just outsource all your manufacturing all the time into a different economy is not always although it might be efficient economically, that's not always the best thing to do from a national security point of view. So he said this lack of manufacturing in the US really presents a security issue. He imposed a state of emergency, and through the state of emergency was able to create an executive order around these tariffs. Usually tariffs are actually up to Congress. Congress would usually set trade policy along with the Treasury Secretary. So this is quite not unprecedented, but quite an unusual move in terms of Trump. And I mean, he's obviously been all about the executive orders since he took office a few months ago. So quite interesting in how he's done this. Essentially, the calculation of how they've done this, guys. So it's not just about tariffs. They actually talk about non-tariff trade barriers, or tariffs and non-tariff trade barriers. Okay, so what they're saying and how they've calculated it, it's a bit clunky. It's not super scientific, but it's a good starting point. As they've said, I've used the example of the EU here. So EU has been imposed with a 20% tariff from the US. Essentially, what they did was they took the deficit in goods with the EU from last year. So that's the trade deficit. So that's how much more the balance of payments. So essentially, the US is importing $236 billion worth of goods more than the euro imports from the US. So they're taking in more than they're exporting to the value of 236 billion, and their total imports from the EU is 606 billion. Okay, so that's the difference in imports divided by the total imports gives you about 40%. And then what he did was he just divided that by 2 across the list. So if anyone watched his announcement, he had the big chart showing all the numbers. He essentially just took that number and divided it by 2. And that's how he got to the 20%. But the important thing is this is not just about tariffs. So it's not as though Europe across the board has a 40% tariff on the US. That is not what's happening. What Trump is saying and what the administration is saying is that it's not just about the tariffs, but there are other non-tariff trade barriers that restrict the US's ability to export into the rest of the world. Some of those could be subsidies. So where these nations subsidize certain parts of their industry, which make it impossible for other players to come in, they generally would fund that with VAT. Another one would be excess regulations. So, for example, I mean, actually, my wife used to work in a company that exported to Europe, and they needed the CE mark to get their goods into Europe. Eventually, they gave up on it, not because the goods weren't of a high standard. It's just because the cost of getting the CE mark and the audit was so expensive that it just became prohibitive. So, those kind of things. Quotas, for example, so limiting goods, for example, so limiting the amount of goods from offshore. So it's not a tariff, but it's just saying you're only allowed to bring in X amount of goods in this particular economy or industry. Things like, and then regulation, things like, for example, agricultural products from the US are not allowed to be exported into the EU just from a regulatory point of view, but no other reason. So Trump's seeing all that as fairly arbitrary and unfair on himself. So that's the kind of where Trump's coming from, and so philosophically you can understand where it's coming from. He's saying, look, we've got a security issue. We're not able to manufacture our own goods or a lot of our own goods, and the rest of the world is fleecing us and using us by incorrect or unfair trade with unfair trade flow on either end. So it's not just a tariff, it's everything else. And essentially that's how they came up with this calculation, is they just said, okay, well, what is all these things, what is the result of those? Well, it results in this deficit divided by the imports, and that's how he gets this 20%. So what's that resulted in? You just look through, we picked a couple of countries. So obviously Vietnam quite highly hit. Vietnam, obviously a lot of manufacturing going on in Vietnam. A lot of US companies have outsourced their manufacturing to Vietnam. A lot of the, shoe companies, clothing companies, that kind of thing. So really what this shows you, the maximum imposed tariff, funnily enough, was 50%. And unfortunately, that actually went to Lesotho, believe it or not. So Lesotho are exporting a lot of textiles, a lot of denim textiles and things like that to the US. So like Levi jeans, for example, we use denims imported from Lesotho. So it's kind of like a across the board kind of implementation at the moment. And now the question is, where do we go to from here? So what he has essentially done is he's imposed a minimum tariff across the board at 10%. So companies like Australia and the United Kingdom will be hit with a 10% tariff. Australia and the United Kingdom actually have trade deficits with the US. So the US actually has a trade surplus with them. They don't have tariffs, but what Trump is saying is that they would have a higher surplus if it wasn't for some of the barriers that are imposed. So he still thinks, even though there's a trade surplus, sort of asymmetrical trade relations on either end. But then a lot of the rest of these countries have a form of tariff, and obviously those non-tariff trade barriers that I'm talking about. So you see South Africa here, we sit at 30%. So obviously we don't have 30% tariffs on the US in terms of most of their goods. But again, trade barriers, regulatory issues, things like that come into it. So what he's done is he's imposed this unilateral tariff, minimum of 10% across everyone pretty much, okay? And if you look at how that's affected globally, who are the sort of nations most affected? You can see sort of some Southern African nations, Europe pretty badly hit, and then Asia. So Asia, obviously the most hit in terms of the tariff impositions, and that's really because of manufacturing. So what Trump wants to try and do is take some of this manufacturing and bring it back to the US. That's the goal here. Whether he can do it or not remains to be a question, but that's the goal. And then obviously also with Europe obviously also outsourcing a lot of their goods. Trump wants to be able to have better negotiations or better relations with Europe in terms of where they're manufacturing or where he's manufacturing, where the US is manufacturing into Europe as well. So really this boils down to China. And I think all of this is a very kind of clunky way of trying to sort of impose or change the kind of manufacturing regime, the world manufacturing regime in the world at the moment around China. A lot of these countries like Vietnam, for example, what China's done and why Vietnam has such a high tariff imposed on it is actually a lot of Chinese companies are manufacturing now in Vietnam as well, and a lot of these Southeast Asian countries, in order to get around the tariffs that were imposed on them in the first Trump administration. So Trump did come in and impose tariffs on China. Biden actually kept those tariffs on, but what China has done is they've moved into these other nations and are just bypassing a lot of the trade. That's another reason why he's kind of put in this blanket trade across the globe so that countries can't do that. So China can't go to a, whoever, a country, Ethiopia or something, and say, okay, please manufacture for us, and then we'll bypass some of the tariffs like that. So it's all very interesting at the moment. The question now remains, how serious are these tariffs and what happens going forward? So are these tariffs here to stay, or are they bargaining chips? Now, if you I talk a lot about the man. If you're trying to understand the man, Trump himself, and where he comes from, and if any of you have read his books, he's very much about setting leverage. So he's a very transactional person. He's very much about the art of, he wrote a book about the art of the deal, and it's very much about setting leverage. Okay. And we've just highlighted the art of the deal here. This is his book, The Art of the Deal, the sort of big kind of tenets and the principles around what he looks at. And we've highlighted some of them, but the one is use your leverage. And what Trump is trying to do is or what we believe he's trying to do is he's trying to create maximum leverage. So what he's gone and imposed all these tariffs. We think that is the max. So it doesn't get worse than that. That's the ceiling. And then with time, or when countries start coming to negotiate, that drops down. We think the 10% base tariff is probably more of a permanent situation. We do know that Trump still does want to onshore, and he does want to bring some manufacturing back to the US. So we do think that'll probably stay. That's probably a longer run situation. But those tariffs in excess of 10%, we think are, for the most part, a bargaining chip. Now the question is, what are other nations, what are other leaders doing about this? And that's really the question. Does this translate into a larger trade war, or does it get neutralized? And I think you're going to see a mix from different areas of the world. So for example, China's already come out and said, well, they're going to impose a 34% tariff back on the US. So a lot of rhetoric going on there. But other places like Vietnam have come out and said, well, we want to scrap all our tariffs now and we want to be able to trade with the US. So, Europe is there's been a bit of political posturing in Europe, but for the most part, I think they are very willing to negotiate. So I think what's going to happen is, and this is almost part of Trump's plan, he wants to rejig global trade, and he almost wants to have your green countries that work together, that have reciprocal trade, free trade, fair trade, that's not asymmetrical. And then you'll have the countries outside that, for example, the Chinas of the world, that probably aren't going to comply to something like that. But what that's going to do over time is it's actually going to kind of hollow out China. And I think that's what he's looking for. He's saying at the moment, the US cannot rely on cheap Chinese manufactured goods or outsource Chinese manufactured goods to Southeast Asia. They're running a $36 trillion trade deficit, debt. They've got a $1.2 trillion trade deficit per annum. This is not sustainable. And at some point, something's got to give. And he sees himself as a person to kind of make this happen. Now, whether that really happens in reality remains to be seen. How effective can this be? But that's essentially where we find ourselves in terms of the tariff. So we think, it's very fluid at the moment. There's a lot going on, new information coming out all the time. There'll probably be new information out today. But we think that for the most part, countries that Trump would like to trade with, or the US would like to trade with, will start negotiating better trade deals on both sides. And then those other countries probably sit outside of that. But remember, the US is the biggest importer in the world by quite a margin. And really, these other countries, if they want to, if they don't want to cause economic crisis in their own nation, are going to have to come to the party to some extent. So, he's got a lot of this leverage. So he's got this leverage. The size of the US economy is huge. And now he's just imposed these massive trade tariffs. So that's the leverage he set up. Now it's about negotiating forward. So he set up the leverage. We really believe that, now it's the negotiation stage. So we think you'll probably, for the most part, most of these nations will come to some kind of amicable and fair agreement. So me being a free trade guy, I would rather live in a world where there's no tariffs or anything like that, free trade around the world. But that's a pure economic consideration. There are political considerations you have to take into account, and the one being obviously, what does this do economically to your enemies if you just allow free trade to go through? Because a country like China, Trump will argue that, well, they use child labor, for example, they subsidize. It's not really fair trade. Those aren't tariffs, but it's not free and fair trade the way he would want it. So from that point of view, economically, you can see the argument. The question is, what happens from here? I think obviously he has come out quite strong. I think a lot of leaders would probably not do it this way. But what he's saying is, well, there's no point in trying to negotiate with Vietnam from the grassroots up, because they're just going to say, well, we've got regulations. There's nothing we can do about it. So he wants to create that kind of impulse to move. And I think that's why you've seen this big tariff announcement. Just a couple other economic issues. In my first table in the beginning, I sort of went through this, but the next sort of things on the Trump agenda. So he's obviously come through. He's like a bull in a china shop. He's done a lot in the last few months. But the next thing sitting in Congress right now, the tax cuts that he wants to propose. So firstly, he wants to the tax cuts, the temporary tax cuts that he implemented in his first term are actually due to expire at the end of the year. He wants to make those permanent through Congress, and he also wants to drop them a little bit more. So he wants to bring corporate taxes in the US down from 21 to 15%. Why? Obviously, if higher tariffs stay on the cards for longer, obviously that is going to have an import or a cost increase on many US businesses, at least in the beginning. But with lower taxes, they'll be able to absorb some of that. Also, he wants to actually make it attractive for businesses to set up in the States. So he's always said, there's one way out of the tariff. If you're a business, not if you're a nation, but if you're a business and you want to guarantee no tariffs, just onshore, just set up your manufacturing business in the US and you won't pay any tariffs. So he wants to attract businesses. So he wants to make it as attractive for businesses, manufacturing businesses, to come into the US and to start trading and operating. And then also the existing businesses to just help them with those initial potential increases in import and supply costs into their process by allowing them to absorb some of that with a tax cut. He also wants to cut individual taxes quite significantly. So he's got no tax on tips, he wants to not tax overtime anymore. He doesn't want to tax social security benefits. And it's also what he wants to do for the car industry. He's quite focused on the car industry in the US. What he wants to do in the car industry is he wants to essentially make it if you buy an American car, that your interest is actually tax deductible. So the interest you pay on your car if you buy US is a tax deductible interest. So all these things, tax benefits for both businesses and individuals, offset some of the tariffs that he's trying to do. And as I said, what he's trying to do is if you look at government revenue, a lot of it comes from tax on corporates and incomes. He wants to try and reduce that and then offset that with higher tariffs. That's essentially the goal. So that's why I think you'll see that 10% base tariff probably staying, because that's going to cover a lot of the offset here. And that's what he's trying to achieve. That will still bring taxes down overall. He does want to shrink the government. He does want to deregulate a little bit, and that's where Doge comes in. So you've obviously seen Doge being quite prominent. Currently to date, I think they've only been in for a few months. They've saved about $140 billion per annum so far. I think you'll probably see more there. There's probably a lot of hype in it. I don't think they're going to go and cut 50% of the US government spend. But if they could do 5 to 10%, that's quite significant and changes the balance of the numbers. The US sitting at $36 trillion of debt, not sustainable. So that's kind of where we see ourselves at the moment. What does this mean for interest rates, inflation, growth, things like that? So you just look at this chart on the right. This is just US PCE. So it's just a measure of inflation. It's the measure of inflation that the Fed uses. Come off quite a bit. If you look at Trump's first term tariffs, they weren't inflationary at all. Interestingly here, what you can see is what caused the big pop in inflation here was actually the fiscal stimulus. So this was the COVID stimulus. So this was when the government started paying people money to just spend. And that's really what caused inflation. But inflation come down since then. We still think it'll probably move down towards its 2% target over time. We think if the tariffs remain permanent, it's actually going to be deflationary over time. So what will happen is you probably get a little bit of a shock in prices initially, but that's also debatable because it depends on what the companies absorb and what they are able to pass through because of tax savings and things like that. But let's say you got a shock, but then what happens after that is you would actually get a sort of, so you might get a short-term price shock, but then you would get a sort of drain on demand, because at the end of the day, a tariff is a tax. If you put a tax on consumption, it's essentially a tax on consumption. If you put a tax on consumption, you actually drop demand. What happens, supply demand, what economics 101, if you drop demand, what generally happens is the price comes down, the market price comes down, and then the volume of goods comes down as well. So you'll probably see, so that'll actually be deflationary, but then you see that the price comes down to lower than it would have been without the tariff, but then you add the tariff on. So the overall price is up, but that's only a once-off shock. Once that's gone through the system, it's already in the system. Remember, inflation is about constant increasing price moves. It's not about a shock. So you might get an inflationary shock, but then you'll get sort of this drain in demand and it'll actually be deflationary. And over the long term, you'll see more businesses onshoring, moving their factories back to the US if the tariffs are permanent. And that's a big if the tariffs stay permanent. If temporary, which I think we'll see now, we'll start to see these negotiations. I think you'll see a move to more free trade, and that's probably a good thing because ultimately, as I say, from our point of view, ideologically speaking, if Europe and the US have no tariffs and no barriers on each other, that's the first prize. But you can't have the situation where one is kind of imposing all these trade barriers and the other one is kind of getting fleeced by it. And that's really so what Trump is saying, well, if you're going to do that, we're gonna tariff you back. Ours will be in the form of a overt tariff. But ultimately, long term, you would want to see those two economies actually trading in a more free way. So I think, you're going to see the move to more free trade. And I think that's good. That'll be good for growth as well because it removes just unnecessary regulatory burdens and things like that. So going to be interesting to see what happens there. But regardless of whether you see the tariff sitting permanently or stay or being more temporary, we think inflation, unless you start seeing big fiscal spending, inflation's under control. And you've actually seen that in the treasuries. We've owned quite a bit of US treasuries for a while, and they've actually done very well. They've rallied through this. They're actually the only asset class that has rallied through all this. And it's because, I think the market's starting to understand that, wait, this is not going to create this runaway inflation. If anything, it's going to be deflationary. And to the extent that it has an effect on growth, interest rates would also need to come down. So, treasuries at the moment, before this announcement, were pricing in 2 cuts. Now they're pricing in 5 cuts this year. So quite interesting. So rallied quite hard. In the short term, the uncertainty over the tariffs might create some economic pain in the short term, because obviously what the corporates are going to do, they're not just going to suddenly start rejigging their whole supply chain. If you're a CEO in a US business that outsources your manufacturing to Vietnam, for example, you're not suddenly going to bring that back because one, the negotiations might undo a lot of these tariffs. And number two, even if the tariffs are permanent and let's say Democrats win in 2029 and just undo all the tariffs, then you're sitting there with egg on your face because you've made this move at your cost. And now suddenly, everything's back to what it was pre-Trump and you've kind of lost out again. So that's going to be interesting to see what corporates do. But for now, you're probably going to see a delayed CapEx spend. So any kind of spending you see on plant, equipment, anything like that's probably going to be delayed. So that could cause some economic pain. And you've definitely seen that in the markets. And that's also one of the reasons why the treasuries have rallied so much. But then you've also got positives that have come out of this. So you've got sort of, if you've been watching the energy prices, energy coming off a cliff. So that's been very deflationary. So to the extent that you get increased product prices in terms of your supply chain, you might have decreased energy costs for a longer period of time. So all these things offset. There's a lot of moving parts, and it's not just as simple as saying, well, tariffs are going to be inflationary. If anything, we think on the balance, deflationary. And then over time, businesses are going to adjust. The beauty about entrepreneurism and capitalism is that people adjust and people make plans, and that's, you never underestimate the ability of that as well. So, just looking at energy, for example, energy come off. So that's after the announcement, it's come off a hell of a lot. It was sitting up at about, north of $70. It's now under, or just probably come back a bit, but just north of $60. So very deflationary. So this is just crude oil at the moment, quite deflationary from an energy point of view. If you look at where inflation sits at the moment, a large part of inflation is still the shelter. So if you look at where this is coming off, so if you look at inflation coming down, but if you exclude shelter, it comes off quite a bit. We follow another measure of inflation called Trueflation. What this does is it actually uses AI, uses a model or an app called Perplexity. It's quite an interesting model on the internet. It's like an aggregator, but it's like an aggregator of search on the internet, but it's got an AI element to it. So it kind of aggregates everything and gives you a nice distillation of what's going on. And what they do is they look at a whole bunch of different goods and services in the US, and then they actually look at real price increases. So at source, what are those price increases? And they're actually predicting inflation to be about actually lower than the official print. So the official print at the moment sitting at about 2.8, I think. They've actually got inflation at about 1.7. So currently, up till this, inflation very low. And then still, as I say, a big part of it is actually this owner's equivalent rent, which is not a real number, which I've talked about before. It's this lagging effect. But if you take this owner's equivalent rent out, there's no inflation. Inflation's below 1.5% in the US at the moment. And as I say, the tariffs coming on board, we don't think are going to be that inflation. So we still like treasuries, and they've done well for us up till now. We'll talk a little bit about how we're jigging our portfolios on light of this as well. Just a little bit of information on China. We think, China at the moment, they're in a bit of a pickle because obviously they've got a lot of threat from the US at the moment. They still export a lot of their goods to the US. They rely on the US and Europe to export to. If those countries start to pressure them and to start to provide, to start being more protectionist with them, it's going to hurt the economy quite significantly. So China's in a bit of a problem. So they've come out and imposed these sort of these reciprocal tariffs. So they already had tariffs on the US, but these sort of reciprocal tariffs or retaliatory tariffs, or they're saying they are on the US at another additional 34%. And they need to now try and fund that. So they are talking about how they're going to fund that. We don't think they have the money or the depth in the economy to actually fund that. So at some point, we think China's going to be forced to negotiate. But if you just look where they are at the moment, I mean, the US at the moment is responsible for 21% of all global trade. And a large majority of that is actually imports. As I said, their trade deficit is about $1.2 trillion a year. So if you look at Chinese inflation, no inflation, it's come off. And if you look at Chinese GDP, it's actually going below zero now. So they're going into recession. Huge problem. And now they've got this headwind on the US. So in terms of investing, we know there's quite a lot of investors that are quite positive on China at the moment. We're actually not that positive on China. We think with these tariffs coming in and this rejigging of global trade that Trump was trying to achieve, we think we think they're probably going to be in a little bit of trouble. They were, as I say, trying to get around that before by offshoring their own production. So going to Vietnam, Thailand, places like that. But now, with this imposition of this sort of global tariff, almost that 10% global tariff, that becomes more difficult as well. In addition to that, they got population decline. So the demographics are not good. If you want to have, so they've been relying on the rest of the world to grow. They've been relying on Western consumerism and Western purchases of their goods to grow. But as the world becomes more protectionist, we think that stops, and then they're going to have to rely on their own economy, and their own economy's got a declining population. So not a great situation. Declining workforce. There's also an aging population, less economically active. So it's really got, so at the moment, things not looking good for China. If you look at our exposure, we did have a specific question on this, and that's why we included it in the presentation. But if you look at our EM offshore exposure through our funds, if you just take on the left, this would be the ACWI, so the All Countries World Index. The blue would be the breakup of developed market versus emerging market. So you can see emerging markets only about 10% of the All Countries World Index. That would make you neutral. So if you're in your equity baskets had 10% to EM, you would be neutral in terms of your allocation to EM. Anything above that is actually an overweight. So even if you had 20% of your fund or your equity carve out in your fund to EM, you're twice as overweight as what the market is. We are kind of underweight across most of our funds. We're neutral on our global flex fund, roughly. So a lot of people have said, why are you so underweight EM? It's not that we underweight EM. It's just that EM itself is not a big part of the global equity markets. And also, we're not that convinced that, like a big part of that, China, for example, we're not convinced that they are the place you want to be invested in at the moment. The rest of the EM space, it's going to be interesting to see what happens with the tariffs, but a lot of uncertainty with all these nations because they've all been relying on exporting to the US, and now that's changing. And remember, contrary to what everyone's saying, this is going to affect the rest of the world more than it affects the US. The US is the biggest economy and they're the biggest importer. Those other countries that are exporting to the US, if that becomes less competitive due to tariffs, that's a huge problem for those nations. And that's why you're going to see a lot of them start to negotiate. So just remember that as well. A lot of people are just focusing on what this does to the US. It's got a huge implication for the rest of the world as well. And that's probably a bigger implication. Vietnam needs the US more than the US needs Vietnam, if that makes sense, in terms of economic growth. If you include South Africa, so this is our EM exposure excluding South Africa. If you include South Africa, obviously we are SA funds. Remember, South Africa is an emerging market itself. So then you start to see, because we've got South African exposure and we want to hedge against those liabilities, then you start to see a lot more kind of emerging market exposure if you ring fence or you include South Africa into that space. So just in terms of, yeah, we did have questions around our EM views, neutral to negative, but obviously still very diversified portfolios. But we'd rather diversify with more DM, developed markets, just because we do have a lot of South African exposure, which you would consider as an EM anyway. SA markets. So obviously that's what happened globally. And then you had the sort of local situation with the fiscal framework. So let's talk about the tariffs first, or South Africa's exposure to the tariffs. Actually fairly limited. So we've been, what's the effect for a goer if Trump becomes more protectionist? This kind of undoes all that. So there's no more, I mean, this actually supersedes a goer, so it goes out, but a goer is only about 4% of our exports anyway to the US. But if you just look, even under this new dispensation, we've been given this 30% tariff. Large parts of our economy are actually exempted from the tariff. So things like PGMs, for example, precious metals, chemicals, most chemicals and things like that are actually exempted from the tariff in any event. The big things that are affected by our tariff are the automotive, and that's the actual 25%. It's a separate tariff, 25% automotive tariff, and then agricultural products, some of our wines, things like that. So there'll definitely be industries in South Africa that are affected and impacted. But overall, as a globally, as an SA economy, it's going to be fairly muted in terms of the effect at the moment. So yeah, but I mean, if you're an agricultural exporter, so like a lot of our citrus products will be exported to the US, things like that, that could have an impact. But anything, you've seen this indiscriminate sell-off in the market, though, things like the taken up, but actually no tariff on the PGMs. The bigger impact, I think, locally is the implementation of, or the vote into the fiscal framework, so the approval by Parliament of the fiscal framework. So essentially what happened there, a bit of a mess up. So you needed obviously parliamentary approval to approve the fiscal framework. That's to get the budget across the line in terms of the 50% VAT this year and the 50% VAT next year. What happened is at the last minute, the IFP and Action SA came and said, okay, we will approve the fiscal framework, but we will approve it subject to certain conditions, subject to certain recommendations being looked at after we've approved it. That is constitution. It's non-procedural, and it's not, and constitution, you actually can't do that. So what actually needs to happen is you need to vote on a fiscal framework and approve it or don't approve it. You can't approve it subject to conditions, because the conditions that you change aren't what's been approved. So it's a procedural issue, and that's what the DA is now going to fight in court. So I think the Action SA, I know what they were trying to do. They're probably trying to come in and say, look, we'll show the country that we can negotiate with the ANC. We'll get the VAT off the table. The DA couldn't do it, and it's kind of like a political game. But what they didn't realize was, in approving that fiscal framework in its form with the 50% VAT increase, that's locked in. That's how it's going to be. And obviously now they're looking like they've got egg on their faces. Everyone's now set to pay extra 50% VAT this year, and pretty much for essentially what looks to be a mistake in understanding the procedure of it. But anyway, the DA is taking this to court. But what does this do for the DA? What does this do for the GNU? It's going to be very interesting to see, obviously, the impact, and no one knows yet. So we've really got kind of two prongs at the moment that we need to worry about. We've got, what's going to happen with the GNU. And in terms of Trump, although he's now tariffed us along with the rest of the world, there's a lot of political noise around what's going on there in terms of potential sanctions on ANC members and things like that. So, I mean, obviously they've been looking at this. There was that congressional report that was released around, certain ANC members being implicated in cozying up to Russia, cozying up to China, cozying up to Iran. So that's still going on. That's still very fluid. And then you've also got this, what actually happens to the GNU. So ultimately, look, locally, from the political landscape point of view, I think it's probably healthy for the country to have some disagreement. We are no longer a country of a majority party. It is going to create noise, a lot of noise, potentially some pain in the short term, but I think probably needed in the long term, medium to long term. And I think probably, things aren't looking as bad as what the media is making it out to look at in terms of the GNU. I think that the DA will probably stay in the GNU for the foreseeable future. you see, both the ANC and the DA know that if they break up the GNU, a lot of their corporate funders and their corporate donors are going to pull out and stop funding them. So they both actually have kind of skin in the game in terms of fundraising to keep the GNU going, even though there's a lot of rhetoric between them within the GNU. So interesting, but I think the DA, it's the first time they've really been able to kind of put weight behind their position in the GNU. Obviously, there was this kind of perceived failure that they had around NHI, around the Bella Bill, and around expropriation bills. But those were all actually promulgated before this new parliament. So they were quite limited in terms of what they could do there. This is the first time where, something has come onto the parliament, onto parliament's purview, where they have been in the GNU and where the ANC has been below 50%. So very, very good, I think, from the DA to kind of hold a hard stance on this. I think good that they're taking this to court. I think they should fight it and show that they're not just going to be walked over. I think, the country needs to see that. I think before this tax vote, a lot of people were wondering why the DA was involved in the GNU at all. Probably a bit unfairly, as I said, a lot of those acts were already passed in an old National Assembly where the ANC still had more than 50. But going forward, I think this is good. So bit of noise around this, but I think for the most part we'll probably be okay long term. Bonds still offering good value at the moment. So if you just look where our bonds are at the moment, so this is the yield, this is the duration. They have been sold off over the last week quite a bit, but we just think that's just a buying opportunity, just offering more potential going forward, a high yield. But you can see the yield duration where we're sitting now, very attractive. So we had high yields, if you look at Nenegate, we were down there, lower yield, high duration. So we had high yields and we had lower duration. So lower interest rate risk right now. So bonds looking quite attractive. So we still like the SA bonds. We just keep buying into weakness. As you see weakness, you buy in and giving us good yields and doing quite well. We've obviously seen a sell-off in the rand quite significantly over the last week, partly to do with the local situation, but partly also to do with what's going on globally. So where to from here? What's going on forward? We still like the US very much. So everything around the tariffs has been US focused. What's it going to do for the US? What's it going to do to the US? But actually, the implication for a lot of other nations is higher than it is for the US. Markets have been sold off quite, US markets in particular, but global markets have been sold off quite substantially, and we're just seeing a lot of opportunity. So a couple of reasons we still like the US and why we like to invest money there. Innovation. America innovates. At the end of the day, we're all about innovation. You've heard us before. We're about the secular long-term trends. We're not about short-term cycles. We're not about revaluations and PE multiples. We're about long-term innovations, getting secular trends and understanding how that works. And that's how you make money in the markets long-term. So if you just look, another one. So these are all offshore. All foreign innovators in the US. So if you look at the US, so these are all inventors who are immigrants in the US. And you can see how many people go to the US. So if you're an ambitious business person and you're an innovator, you've invented something, you're going to the US. So it's just that capital, that human capital that the US has, that's just not, if you look at China, China's negative. China's actually got people leaving to go and innovate elsewhere. If you look at India, the same thing. India's biggest export is its people. Actually, it's tech people. It's got some of the best, funny thing is, it's got some of the best technological-based universities in the world, yet it can't capitalize on it because everyone's going to the States. So the States are still able to capitalize on that human potential, which we think is just huge going forward for investment. Skill and execution. Again, the people, the top universities of the world are all US based, again, access to capital. So deep capital markets, private capital. If you need to borrow money for a crazy investment idea, chances are the States is your best. Go and try and raise money in France, in Paris. It's not going to be as easy as raising money in Silicon Valley, Now that comes with this risk too, but that's how you get these big players and how you get the big winners, right? And then global reach, a number of cross-border listings in the United States. There's 101 of their top companies that actually have multiple listings on different exchanges. So you've got that global reach. So, although we say we like the US businesses are global businesses, and Amazon is a global business, and Apple is a global business. There's just no equivalent to those businesses anywhere else in the world. You could argue maybe Samsung is equivalent to an Apple, sure, but at the end of the day, you've got those global businesses that are based in the US. So don't think of it as essentially US. Think of it as just access to the globe through the best means possible, and that's why we like the US. Another opportunity and why we like the US is if you see the trade balance. So what Trump is trying, so this is the amount of imports minus the exports, or the exports minus imports in the US. And you can see they've been running about $100 billion a month in terms of deficits, meaning that they import $100 billion a month more than what they export. Trump is trying to get this to turn. This is the whole point of the tariffs. He's trying to get them more onshore. He's trying to get the US to export more to the rest of the world. So he's trying to get this line to go up. What you can see is over the last few months, it's gone the other way, and there's a very simple reason for that. Is a lot of the American corporates were trying to front run the tariff. So they're trying to say, let's go and import goods. Let's get goods in before the tariffs get implemented, which is obviously a natural phenomenon. But that's going to unwind quite significantly going forward. You can see that this has resulted in quite a weak US dollar. So the US dollar is weakened to the euro by about 9% in the last 2 months. So it was actually close to parity. The end of last year, it was almost 1-to-1. Now it's about $1.10 to every euro. So it's come down about 9%. It's quite a big weakening also, again, to the pound as well. And that's because of this front running. What you're going to see now is you're going to start seeing this turning. One, as this needs to now roll through, you've got all these companies that have a lot of inventory on their balance sheets now that they need to use. So that'll turn. So they actually go below because they've obviously front run. They've got extra inventory in their warehouses. And then two, also the tariffs coming into place should make this more competitive. So you should start to see when these countries come and negotiate with the US, this turning and coming up. That should be quite strong for the US dollar too. So we think now you can actually buy equities in a market that have been sold off quite a lot at a cheap currency as well, relative to the other major global currencies, not relative to the rand, right? Just looking at it, the NASDAQ and the S&P, this is their drops as of yesterday. So NASDAQ's already down over 20%, quite a significant drop. You can see these drops have happened fairly often. This was COVID. You can see this was when they started raising rates quite substantially in the US, when they started going from 0 back to about 4 or 5%. There was a slower burn, but you can see this COVID shock. This is very much like the COVID shock. So we're not saying we're at the bottom. We don't know where the bottom is, but at some point, things will normalize and you're getting great opportunities. So US markets roughly 20% down at the moment. They've come down quite significantly. They generally, if you look historically, you want to be buying in the dips. So we have started to upweight. We started to take some of our treasuries off the table yesterday and started to nibble into the markets a little bit. We think you're getting really good opportunities. And ultimately over long term, markets are still doing well. If you just look, what it's done, take NVIDIA, for example, we like to talk about NVIDIA. We like NVIDIA. It's on a forward PE at the moment of 20 times. So this is just price to the next 12 months expected earnings. And you can see it's actually very rarely this low. The last time it was this low was pre-COVID. And we all know what NVIDIA has done since that time. So there's been times where it's looked quite expensive. Even there, it wasn't actually that expensive. The earnings come through. So that's the thing about a business like this. It's expected to grow its earnings at 45% over the next 12 months. And then thereafter, another 30-odd%. So, these things starting to look very cheap. So we're starting to nibble. We're starting to look at increasing our tech exposures a little bit and really taking advantage of what we're seeing here in terms of the market drawdown. You want to buy when things are low, and unfortunately, sometimes you got to hold your nose, because when they're low is when the most noise is around. When the world's about to end, when COVID was ending, that's when everyone was selling, but you really should have been buying. So looking at really starting to look at the stock market, and as I say, the treasuries have provided some nice protection. So US treasuries, just since January this year, the orange line is the US treasuries, and people are saying, why are you owning treasuries? We think inflation's coming. Do you really want to be in the treasury market? And we said, no, just, they provide good protection on a downswing. And number two, we don't think there's going to be the inflation people think. And that's what's playing out. So the treasuries have done very well. The equities have sold off quite a bit. So what we've started to do is we've started to take from here and we started to allocate to here. Now, I don't know if we're at the bottom or not. If we continue to drop, we'll allocate some more. It's about managing your risk and it's about looking for those opportunities. But really, I mean, that's what those are the kind of opportunities we're seeing in the market at the moment. Again, these we've shown you this chart before, these like paradigm shifts, the PC era, the internet era, mobile, social media. This is where NVIDIA sits in the AI era. Now, all of these had their own bits of sort of wild rides, their drops, their corrections. NVIDIA's having one now. But ultimately, we still think huge opportunity going forward. This is a log scale, by the way. So that's from 10 to 100, not from 10 to 20. So just remember that as well. It's actually an exponential curve. So still seeing a lot of value. Like I said, so in the US, to sum it up, we think, it's sold off enough now that we already liked US equities before. We like them just more now. We have protected a lot of capital. We've used the treasuries that have done well to start buying those equities up. And that's where we sit at the moment. So not to say that the noise is over. I still think there'll be a lot of noise around this. The next thing is interesting, and what we're going to be watching going forward now is really around what do these other nations start doing? What are the negotiations? What comes out of this? Is Trump going to back off from the setting in, as I say, set himself up with the strong kind of initial leverage now? Now, what happens going forward? And we know that that's his tactic. We know how he thinks, and that's what he's wanted to do. Now the question is, how willing is everyone to negotiate and go forward? Our hunch is that those tariffs will start to come down fairly quickly. You'll still get the 10 base tariff we think is going to be around for a while. But that shock reaction to those massive tariffs, we think probably overdone. And we like the opportunities we're seeing in front of us right now. So that's kind of it in a nutshell, guys. Always got to look for where you can make money in these markets, and that's where we sit at the moment. So happy to answer any questions and take it from there. But thanks, guys. Sorry about the delay with the switch over the technology. As an asset manager that likes tech, it let it down a bit today. It's okay. But yeah, thanks, guys. Thank you for your time. We will obviously keep you posted if there's any more developments going on. But that's where we sit at the moment. We are in a good place, we think. And looking forward to what happens over the next few months. Any questions? But if you need to leave, please, guys, leave. We'll apply for CPD, but anyone who wants to hang around and have a discussion, you're welcome.
Well, thanks so much, Paul. I don't see any questions in the chat at the moment. So you are welcome to put your questions in the chat. Otherwise, if you'd like to turn on your mic and ask, you're also more than welcome to do that.
Thanks, guys. All the best.
Question.
Oh,
No
sorry.
question. Unbelievable. Paul,
Shanda?
Paul, just a question for me.
Yes, go for it.
With regards to the opportunity fund, you mentioned a while ago to me that you follow the passive approach. At this stage, will you continue with the passive, being more passive than active managing in the portfolios?
Yeah, so we still our equity increases that we just bought actually NASDAQ. So, we've held NASDAQ for a while, but we still, so yeah, we prefer to get the majority of our exposure through, I suppose it's not purely passive, it's buckets, it's ETF. So we'll use, we've got our semiconductors, we like tech, we've got NASDAQ. So it's not broad market. We still own the S&P 500, of course, that stays. But generally looking at those kind of thematics around, so it's passively managed indexes, but not quite the same, the normal broad market cap exposure, if that makes sense. So yeah, but to answer your question, yes, the strategy is pretty much the same. Yeah.
Okay, happiness. And then just with regards to the rand, you guys happy to allocate at this levels? You're not gonna wait for the rand to strengthen a bit, I assume.
Yeah, so I mean, when the way we think about the currencies are the relative currencies to the peer group. So the rand, you could argue is very weak. What we are doing at the moment is we're taking treasuries that are already priced in dollars and just buying equities already priced in dollars. So there's no, we're not like selling like SA assets to buy offshore assets at a bad rate. And then just thinking about how the dollar we think will appreciate against the pound and the euro going forward. To try and obviously time it local, offshore is difficult. But our local and offshore exposures are not changing at the moment. It's just the asset allocations within those buckets are changing at the moment.
Cool.
Yeah.
Paul, Johan here, question from my side. With inflows coming into the funds, are you in a better position or stronger position to actually allocate the funds, or are you holding on to cash? Or are you
Absolutely.
bonds?
That's a good question, Johan. So actually, we have been quite blessed and fortunate at the moment to be having a lot of inflows. That just helps you rebalance quite efficiently and quite quickly. So we've actually been using a lot of that cash to buy equity.
Okay.
Yeah.
Cool.
Yeah, that's another. You don't always need to actually sell something when you got cash coming into the funds. It's a good point. You don't actually always need to sell to upweight asset class. You can just use the cash that comes in to upweight the asset class, which is quite nice. So we have been in a fortunate position that we are getting inflows at the moment, which is nice. I think there'd be some funds out there probably getting outflows. It's harder for them to they're almost forced sellers, and we can buy the opportunities we see. We don't have to sell things, which is quite nice.
Yeah, thanks for that.
Perfect. Cool, guys. I don't know if there's anyone else who has any questions, but I think with that, we can wrap it up. Obviously, you're always welcome to speak to the team or myself about anything going forward. But thank you for your time once again, and yeah, we'll chat soon. All the best.
Thanks everyone for joining. Yeah, with that, we'll wrap up the update. Like Paul mentioned, if you have any additional questions, please be in touch with any of the New Road consultants, and we'll be more than happy to answer it for you. So thank you all for joining today.